If there is one area where founders consistently struggle during a capital raise, it's financial modeling. Not because they're unintelligent, but because most entrepreneurs were never trained in capital markets, forecasting discipline, or investor communication. Most founders build budgets. Investors, however, expect models, dynamic, structured, assumption driven frameworks that reflect how a business actually grows. Today, we're going to break down the exact components investors expect in a financial model, including revenue modeling, cost structure, unit economics, gross margin and contribution margin, EBITDA projections, cash flow projecting or forecasting, sensitivity analysis, return metrics, scenario planning, assumptions justification. This is the same structure used by venture funds, private equity firms, investment banks, and public market analysts. Let's start at the foundation. The purpose of a financial model. A financial model answers one core question. What will this company realistically look like financially over the next 3 to 5 years? Not what the founder hope it will look like, but what the economics demonstrate. A strong model gives investors confidence in management, transparency into assumptions, insight into scalability, understanding of risk, evidence of operational discipline, a grounded basis for valuation, and a weak model does the exact opposite. The 4 parts of a complete financial model. Number 1, revenue model. Number 2, expense model. Number 3, cash flow model. Number 4, key metrics and scenarios. Let's break down each one. Revenue model. How money actually enters the business. Revenue modeling is not guessing numbers. Investors want to see revenue broken down logically by customer segments, products or services, pricing, volume, conversion rates, retention, seasonality, growth drivers. A credible model shows how revenue grows, not just that it grows. If your model shows revenue jumping from 2 to 10 million in 1 year, investors will ask, what mechanism drives that growth? Is it more customers, higher pricing, new markets, larger deal sizes, additional salespeople, new distribution channels? Every number must have an underlying assumption. Break down revenue into units. Sophisticated models separate price times volume equals revenue. For example, number of customers, average revenue per customer, repeat rate, upsell rate, contract length. This creates traceable logic instead of random numbers. Revenue should connect to CapEx and use of proceeds. If you plan to hire 5 additional salespeople, the model must reflect ramp-up time, productivity curves, lead flow requirements, CAC impact, margin impact. Everything must tie together. Number 2, the expense model, where money actually goes. Expenses break into 2 categories, fixed costs and variable costs. Fixed costs include salaries, rent, insurance, software, administrative fees, professional fees. These remain constant regardless of volume. Variable costs include materials, labor tied to production, payment processing, cost of goods sold, shipping, commissions. These scale as the business scales. Investors care deeply about margin structure because margins determine scalability. Key margin metrics: gross margin, revenue minus cost of goods delivered. Contribution margin, revenue minus variable cost. EBITDA margin, operating profitably before non-core expenses. Healthy margins create valuation leverage. Weak margins create investor skepticism. Number 3, the cash flow model, your survival mechanism. Many companies grow revenue but still run out of cash. Cash flow modeling prevents that. Investors want cash runway, monthly burn rate, working capital cycles, accounts receivable timing, accounts payable timing, seasonality, debt obligations, and CapEx requirements. Cash flow demonstrates whether a business can survive long enough to actually execute its plan. Growth consumes cash. Cash flow modeling keeps growth controlled. Number 4, key metrics and scenarios, the test of credibility. Investors want to see how your model behaves under different circumstances. Base case, the realistic scenario. Best case, if everything goes right. Worst case, downside protection. Sophisticated founders include sensitivity analysis, CAC sensitivity, pricing sensitivity, margin pressure, and headcount models. Investors will stress test your numbers. A good model holds up under pressure. Why investors view financial models as judgment tests? A financial model is not just math. It reveals how founders think, how disciplined they are, whether they understand their business, whether they understand their risk, whether they understand capital allocation. A model tells investors whether founders are ready for capital. The key takeaway: your financial model is your credibility document. It must be detailed, justified, assumption-driven, and grounded in reality. Weak models repel investors. Strong models unlock capital.